The sell-off continues here. We are looking at the lows of the session right now. Investors are growing concerned that Republicans are not going to be able to move forward on this pro-growth economic agenda. Up until now, Wall Street has, I got to say, remained pretty optimistic, and they've taken everything with a grain of salt. They have been most focused on tax reform and health care reform, and they have assumed it's all going to happen. But now, suddenly, some of that is being put into doubt as we watch a market that's off 348 points amid news of the president's dismissal of FBI Director James Comey and all that that entails, including the memo, et cetera. Joining me right now with a look at how you should be thinking about it, we have legendary investor and Janus Capital portfolio manager, Bill Gross. Bill, it is good to see you, and what a day to have you here.
Oh, thank you, Trish. It's good to be here. What a day is right. You know, the market has been standing still for the last 3 or 4 weeks, and now we've got a big day.
Do you think this is going to continue? I mean, what do you think is behind this sell-off right now, and is it lasting in your view?
Well, I think it's the stronger potential evidence, you know, related to Comey and the FBI investigation, as well as the Russian investigation. You know, all I know, though, about Washington politics, Trish, is what I hear on Fox News. But from an investment standpoint, it appears that the current turmoil threatens, or I think at least delays, the Republican agenda, which you just mentioned, for tax cuts and infrastructure spending that, you know, risk markets were counting on to justify current prices. And I think the summer in Washington is going to be politically focused as opposed to economically focused, and that may stall the markets.
Yeah, I mean, that's the concern, right, Bill, that you get this circus going on in Washington right now, and you have people in the Democratic Party that don't want President Trump there, and they don't want lower taxes, and they don't want repeal and replace when it comes to Obamacare, and so they will do everything in their power to derail that agenda. But, you know, investors, you know, I guess as I look at the market right now, I'm asking you, I mean, do they actually think that the Democrats are going to be successful, or is this perhaps just a blip on the radar?
Well, I think it's more than a blip, and if they're not successful in terms of their ultimate objective, which might be to remove Trump from office, they certainly will delay the Trump agenda and congressional action in terms of tax cuts and deregulation and repatriation of $1 to $2 trillion from overseas, which the market may have been counting on. You know, investors should remember, Trish, that since the election in November, stocks are up 10%. And while, you know, some of that is due to earnings gains and a really good earnings season for the past month or two in terms of announcements, a 10% gain was based significantly on the potential for tax cuts, and that may be delayed, and ultimately it may be forestalled.
You think so? Delayed, forestalled, not happen at all, Bill?
Well, you know, we'll see. I think markets are at levels, not just stocks, but bonds as well, in terms of the low yields that suggest that, you know, future capital gains may be limited. You know, investors are counting on those double-digit types of returns, and I don't think we're going to get it.
Let me ask you about the Fed and their involvement in all of this, because throughout Obama's tenure, Janet Yellen and company were very actively involved. Some might say too involved. And they've kind of indicated that they're not going to continue that. Do you think, given the environment, if we're not able to get stuff out of Washington, if we're not able to see economic policy reform, will the Fed need to be more proactive yet again?
Well, I think they'll need to be proactive from the standpoint of forestalling interest rate hikes. You know, they've talked about 2 to 3 hikes per year over the next several years to renormalize short-term rates and to renormalize bond rates. But, you know, if we have problems here in terms of economic growth, if we have problems in terms of the fiscal agenda that Trump is proposing, then I think the Fed becomes more cautious and, you know, perhaps only raises interest rates by 25 basis points or 1/4 of a point per year, as opposed to the 75 that the market and the Fed were talking about just a week or 2 weeks ago.
Very interesting. So perhaps a more reluctant Federal Reserve there to move on interest rates. Where does that leave yields? What do you think the 10-year is going to look like, say, 6 months from now?
Well, goodness, we're at 2.2%.
Yes,
and
today.
I think, Trish, I think significantly that 2.2% is still very, very low, and that it's related to a considerable extent to German yields and to Japanese yields, and to a certain extent this is a global market, and so the question that you've asked is related to global growth. I do think that interest rates globally will be moving higher. You asked me where the 10-year will be, now at 220. I think perhaps at 250 or 260, over the next 6 to 9 months, but nothing significant in terms of an increase as long as we have these problems in Washington.
Bill Gross, so good to see you. Thank you, sir. Appreciate it very much.